Just so everybody knows, we're going to have this posted into our YouTube channel. So that's coming down the pipeline. So in case if you or your anybody that you know may not have the opportunity to attend today, they can actually go back to the YouTube. Or if you just want a refresher, you can also watch it again. Hey, Mackenzie. Thank you for joining us. Vicky, Scott, Olivia. All right, I think we should just go ahead and kick off and we'll have Carly and Anthony keep an eye out for the stragglers here. Um, but hi everyone and welcome. We're so excited to have you with us today, whether this is your first time joining us or your familiar face. We appreciate you making the time to be here. I'm Tiffany Lunt, and I'm joined by my incredible teammates, Carla Cordovez and Anthony Belcher. Together, we're the team behind Doors, Deals, and Dollars. Our mission is to help investors like you not only get in the game, but also to win big by leveraging smart strategies, strong relationships, and powerful tools like the one we're about to explore today. But before we jump in, we'd love to take a quick moment to introduce ourselves. I'll start off. I'm Tiffany, as mentioned. I'm the director of syndication from Freeman Lunt. I am a multifamily syndicator and a former commercial banker with nearly 20 years of experience in underwriting and lending. After nearly 2 decades in the banking world, I made the bold decision to leave my W-2 and go all in on real estate. Why? Because I have found my passion, and now my mission is to help others do the same. I want to show people how to build wealth through real estate so they too can create freedom, to leave their 9 to 5 if they choose, and then spend more time doing what they love. So now I'll pass the mic to Carla to introduce herself.
Hi, everyone. So one of the things that ties us together as a team is that we have the same mission of providing those insights and bringing that value to people. I live in Fort Myers, Florida. I have over 16 years of experience with different types of customers in different industries. I'm a techie as well, and I own 96 units. A couple are coming in the way. I'm very excited about that. I have experience with land acquisitions, Airbnb, you name it. I love real estate. It is my passion. It's one of the things that also brings us together. So I'm excited for you to be in this call today, for you to be in this webinar, absorb this information. This is very important information that is life-changing once we utilize it the right way. And Anthony, go ahead, kick it off.
Thanks. Thank you, Carla. I'm Anthony Belcher. I bring over 25 years of business leadership and ownership to the team. I drew financial performance. I shifted my focus to the real estate. I actually was a single family realtor for a while. That's how I dipped my toe into it. But now I've turned my attention to the multifamily theater. We basically focus on helping investors grow their wealth. So we specialize in identifying the value add opportunities with strong risk management and provide high returns, all while leveraging the freedom that we've built by running my own business. So excited for you guys to be here, excited for you guys to learn everything and show you how you can save some money on your taxes.
Awesome. Well, thank you, team. Well, today we're diving into a powerful topic that often gets overlooked, but can have a massive impact on your bottom line. Cost segregation and bonus depreciation, a strategy that can significantly boost your property's cash flow and reduce your tax liability. This is a must-know for syndicators, investors, and operators alike. So we're thrilled to have with us a true expert in this space, Mark Gross from CSSI. But before we jump in, just a couple of quick housekeeping notes. Please do keep your mic on mute unless you're speaking, just to cut down on the background noise. And if you have any questions during the presentation, and we hope you do, feel free to raise your hand or drop them in the chat. We'll either address them as we go or circle back during the Q&A session. This is meant to be an interactive session, so please don't be shy. We want you to walk away feeling empowered and informed. So now a quick intro to our guest. Mark Gross is a national account executive with CSSI, the nation's premier engineering-based consulting firm specializing in cost segregation studies. With over 50,000 studies completed across all 50 states, CSI has helped building owners unlock significant tax savings and boost cash flow. Mark's expertise is helping operators, investors, and developers leverage the tax code to their advantage. And today, he's here to show us exactly how that works. So, Mark, we're honored to have you here with us today. Take it away.
Thank you, Tiffany. I appreciate the opportunity. Well, everybody, why don't we get started? I know you've got the screens there for me, Tiffany. Let's go on to the next one. One question I like to ask when I do these type of presentations initially is, why do investors own real estate? Would any of you like to chime in on what you think are some of the objectives of people who do real estate investing? Okay, maybe I'll help you out a little bit. Maybe net operating income, make more money. Very good, Anthony. How about appreciation in properties, growth there? Tax savings. All right, Michelle, I like that. It's a leading question, isn't it? And freedom. There you go. I like that, Michael. Financial freedom. Very good. Well, thank you for those feedback. Well, the next question I have for you on the next screen is it advantageous to quote unquote lose money in real estate? So what do I mean by that? Well, when I get into this idea of cost segregation, you'll understand the advantage of quote unquote losing money and how that can actually be advantageous for you. Now, if we go on to the next screen, you'll see a comment here by one of the senators who talked about a tax loophole is something that benefits the other guy. If it benefits you, it's tax reform. Now, one thing to understand is everything I'm going to be talking to you about today is going to be in the IRS tax code. We don't make any of this stuff up. Tiffany mentioned earlier that we've done over 50,000 studies, and we have. The nice part about that is that we also have never triggered an IRS audit, and we've had clients that have been audited for other reasons, and we've never had a study overturned. Why is that? Because we do it all by the IRS guidelines. So it's not a loophole. It's something that you really need to take advantage of. So let's go on the next screen and you can talk about what is cost segregation. Well, basically is analyzing all the pieces and parts within a property. That's where the word segregation comes from, to be able to identify what are the components within a property that can be depreciated faster. Now, one of the bullet points on here, makes reference to 27.5 or 39 years. Now, would someone like to tell me what's the difference between where does the 27.5 and 39 years come from? Okay, well, the straight line depreciation for residential properties is 27.5 years. So what a CPA will do is take a look at the purchase price, subtract the land value because you can't depreciate the land, and do a straight line depreciation over 27.5 years. Now, again, that pertains to residential properties. All other property types are 39 years. The same situation, you take a look at the purchase price, subtract the land, which you can't depreciate, and depreciate it straight line over 39 years. Now, that's a long time to be able to get your depreciation. By doing a cost segregation, what we're doing is identifying the parts that can be depreciated faster. What that does, it reduces your income, therefore reduces your federal tax liability. So it's a pretty low threshold as far as what works for this. It could be buildings of $350,000 or greater, excluding the land value, and tenant improvements as small as $200,000 in cost. That would be, let's say, someone has maybe it's a retail space or an office space or medical or whatever the case might be, and the landlord frequently will do a tenant improvement and pay for it himself and give some sort of a bonus to the tenant. However, if the tenant pays it out of his own pocket, then we can do the study for them. Otherwise, it would be for the landlord. Now, what's interesting here is when you talk about the low cost ones. One I'm working on this week, one of many, is in California, and it's the ADU. For those of you not familiar with that, it would be an accessory dwelling unit where someone will have on their home, they'll bring in another property that they can rent out, either a short-term or long-term rental. And frequently those would be a lower cost one. So it works not just with your traditional multifamily duplex, large ones, retail. Basically, I've done all property types nationwide. So let's move on to the next page. And how would you describe cost segregation? Well, one way to look at it is when I talked about the 27 and a half years or 39 years, that would be the straight line method. Another analogy for that would be with like McDonald's, that'd be a hamburger. Well, if you take a look at the cost segregation method, and I don't know, Anthony, do you remember this one from the commercial? You gonna sing it for us?
I am not
No?
singing today.
Those of us who are old enough will remember this, and I'm not going to sing it either, but you can read it there. What the cost segregation method is identify all the parts and pieces within the hamburger, and the analogy, of course, is with the building. So rather than look at it as one big unit, you're looking at it as all the pieces and parts within the property that can be depreciated faster.
Mark, one of our attendees has a question that if cost segregation would apply for finishing a basement and creating that into a short-term Airbnb, for example.
It could, but what you need to do is take a look at it would be a percentage of it. And the question there would be, is the value going to be large enough? Is the value of the basement really going to be, $300,000 or greater?
Substantial enough, exactly.
Yeah. So the answer is, it depends. I hate to say that, but that's what it would be. I mean, I'll give you an example. One, I was a client in Oakland, California, where they had a duplex, and they lived in one unit and they were renting out the other one, and they wanted to do a cost segregation on it. Well, I said, well, we can do it, but you can't do it on your primary residence. So we were able to do it on the one which they leased out. But then they said, you know what, we're thinking about selling it maybe in a year. So I said, I said, why don't you just wait on that? Go ahead, and once you move out, then we can do a cost segregation on the entire property. But that's a great question. Cost segregation works well for investment properties. It's not applicable at all for your primary residence. Okay, let's move on here. This will give you an example. Again, people remember with the 39 versus the 27 and a half years. I got a trick question for you here. Let's say somebody has a long-term rental. That's obviously going to be your 27 and a half years. What if they have a short-term rental like Airbnb? Is that still considered residential property? Actually, by IRS guidelines, it's not. It's considered to be a 39-year asset, because that's what a short-term rental would be, similar to what you'd have for a hotel. And it's amazing how many times I'll see depreciation schedules from CPAs who get that wrong. They'll have a short-term rental listed as 27 and a half as a residential property, and it's not. So this will give you an example of some of the things which would qualify under the different elements. So again, there's still going to be a lot of structural components that cannot be depreciated. They have to be depreciated over the 39 or 27 and a half years. That would be, the brick and the structure within the building and things of that nature. You have your carpeting and other components like that, which would be in your 5-year bucket, and your parking lot and things like that for 15-year. So one thing you'll notice up there in the top is it talks about eligible for bonus depreciation. I'll give you a little history and a little background on this. At the end of 2017, there was something which is called the Tax Cuts and Jobs Act. And when that came out, what it basically said, anything which has a less than 20-year life can be depreciated 100% the first year of acquisition. Now we've been doing cost segregation studies for over 20 years. But what that basically did was kind of put cost segregation on steroids, because you could not only do the depreciation for 5-year property or 15-year property, but you could take anything which has less than 20-year life and actually depreciate that 100% in the first year. And that was huge. That was a real game changer. And that's why a lot of investors are doing that. But it had a sunset clause on it, or I should say a phase out, whereby it phased out from 100%. This year it's at 40%. Last year was 60%, 80% the year before, and then 100 before that. It's scheduled to go to 20% next year and 0 the following year. There's a lot of talk about what's going to happen in Washington, D.C. on this. You might hear about some talk about a big, beautiful bill, things of that nature, with the new administration. And what they're trying to do is to get the bonus depreciation back, make it 100% again, try to make it permanent. We don't know, of course, what's going to happen, but the speculation is that when that does come back, it'll probably be retroactive to some date in January of this year. But wait and see. Stay tuned. We'll just put it that way. Okay, let's move on. The next screen here will kind of give you even more detail. I'm not going to read all these things, but you can see a lot of the components which would qualify for the different buckets. And again, with the bonus depreciation, what you can do is take whatever the qualifying year is, you can do it based on that. Now, one interesting fact, and actually I get this pushback from CPAs or others as well sometimes, is that when can you take the bonus depreciation? Is that based on the year in which you do the study, or is it based on the year of the acquisition? And it's actually based on the year of the acquisition. So I'm doing studies right now for clients who acquired properties in previous years when there was 100% bonus depreciation. And what's interesting about that is you not only get that maximum amount of tax deduction, but it does not require amending a previous year tax return. In fact, I had CPA earlier this week telling me, "Oh, well, you got to amend taxes." I said, "No, you don't. There's something called a Form 3115 that needs to be filled out. You don't need to amend taxes. It doesn't make you subject to an IRS audit. It's just a routine thing." We actually can do that frequently for our clients, or else some CPAs that are more well-versed. In fact, I delivered a study today for a client in New Jersey for property they have in Massachusetts, I think it is, and their client wanted to do the 3115. So we don't push it. There is an extra charge for that, but we're very flexible in that regard. And I'll bring up this fact as far as working with CPAs. We don't do tax returns, so we're not in competition with CPAs. But what we do is we work hand in glove with them, which is the reason why I get a lot of referrals from CPAs, because they utilize our studies for their clients' tax returns. So let's go ahead and move on to the next one. This will kind of give you an idea here as far as some of the items for bonus depreciation. And then we can go on to the next one. And what I love about this graph is that kind of depicts what the difference is between the different ones. You can see the straight line method there, and the accelerated one in red, and then also with bonus depreciation as far as the spike in the first year. That was at the time that was 100%. Obviously, that's less than that right now, but let's keep our fingers crossed. We think that's probably going to come back. Okay, let's move on. Now, what are building types that qualify for cost segregation? Really, it's anything. You know, like I mentioned here, I talked about a AUD, ADU rather, and those work out well. Most of my properties are in the millions of dollars. I did one here recently in Arizona, where we saved the client over $1 million. Now, obviously, that was a pretty expensive property, and they spent tens of millions of dollars on it. The interesting thing about that one, it actually, the client was a U.S. Department of Defense tenant. So the site visit was interesting, whereby we were kind of restricted as far as what areas we could take pictures in for national security reasons. But I do all types of properties. And what's interesting is one thing I mentioned earlier was about you take a look at the purchase price, you subtract the land. Well, I on occasion will have people that come to me with a property which is on a land lease. And I'll give you an example. One was a Walgreens in Florida. Well, in that particular case, what you have is you take a look at the purchase price, and since the purchase price doesn't include any land, we could do the cost segregation on the entire property. I had the same situation with some Airbnb condos in Kauai, Hawaii, whereby based on the condo association, the owner did not technically own any land, so therefore we could take the entire purchase price and do that. Another interesting one that you might not think would qualify for cost segregation would be a golf course. Now, what's the one thing that I said you can't depreciate? Well, that's the land. Well, typically what a golf course is going to have is going to have a clubhouse, it's going to have a parking lot area, it's going to have other infrastructure. So there'll be elements within that type of property, or really any type of property that can qualify for that. And what we do is we will provide a free preliminary analysis based on the tens of thousands of studies that we've done, which will give a conservative and a high-end estimate of what the estimated savings are going to be, and then also the cost of study, and no obligation. A client can decide what they want to do, and we turn that around in 1 or 2 business days. Okay, let's go on the next one. Did I see a question there? Do you have someone have a question?
Yes. Are there certain asset classes or property types where cost segregation just doesn't make sense?
Not property types, but one of the pre-qualifying questions we ask is what's your hold period going to be? It's not good for flippers. There's something called a recapture tax. And our recommendation is that you're going to hold on to a property for at least 3 to 5 years, so that the benefit, return on investment you're going to get on the savings is going to far outweigh whatever the recapture tax might be. So that'd be a pre-qualifying question. One of the other ones we ask, and this is rare, it doesn't qualify, because typically people aren't going to ask for this unless they can utilize it, but can you use the deductions? I mean, I've had some people which will say, well, I've got a loss carry forward from some other deductions, and I really can't use this for another 5, 10 years. And we'll say, well, do you really want to do it? So that's one of the other questions. But as far as asset classes, or really, it works with virtually all of them. Again, one of the things I mentioned earlier, where you can't do it for your primary residence, but as far as investment properties, really all of them will do. Obviously, you're going to get a different percentage for different property types based on square footage or dollar amount. Medical facilities, especially, will have a higher percentage because of all the componentry within that type of property. And one of the ones which is still advantageous, but not as high, would be your industrial properties, because you have a very large dollar amount or square footage, and there may not be a lot within that space that can be depreciated.
Mark, let's say I just purchased a home and that I would use it for long-term rental. Who should I look for? What kind of professional should I look for in order to help me do a cost segregation, or can I do a cost segregation by myself?
We wouldn't recommend you do it by yourself, because the IRS recommends that you have a third party, do that. Because one of the things I mentioned earlier is that in the event of an IRS audit, you really want to be able to have substantiation from a qualified service that does cost segregation studies. I'll give you an example of experience I had here just a couple months ago. I did a cost segregation study for a large multifamily property in Chicago. And they contacted me and they said, we're under audit by the IRS and they're asking some questions. The audit was not triggered because of the cost segregation study. It was for other reasons, but while they were in there, they were looking at it. And so they had a laundry list of some questions. I sent it to corporate. In less than 24 hours, I had the responses, and they gave it to the IRS, and that was it. So one thing that we will do 100% of the time is we will always do a physical site visit of the property. There's some other firms that won't do that, to do a virtual one. And we just know that being able to have boots on the ground, to be able to be there physically, we can not only maximize the amount of depreciation, the tax saving, but also be able to have all the substantiation we need in the event of an IRS audit. We want everybody to be able to sleep well at night, knowing they're not going to have any issues.
Absolutely. And what kind of information or documentation does the property owner need to provide in order to give that third party for a cost segregation study and assessment?
Well, one thing that we do is the physical site visit. In addition to that, we might ask some questions such as looking at the closing documents, taking a look at an appraisal, any drawings or blueprints that are available, things of that nature about the property. So all those things in conjunction, our engineers will review to be able to come up with the study. I saw one question there that asked about the cost of it. It's not going to be a percentage based. We don't do it percentage based on what the estimated savings are going to be. It's a flat fee, and it's going to vary depending upon the size of the property. If you have a smaller property, it could be somewhere in the $2,000–3,000 range. We have others that could potentially be tens of thousands of dollars or six figures, but it's all relative. You could, when you get millions of dollars back, it's going to make sense to go ahead and pay a larger fee, and it's based on the amount of time it's going to take our engineers to go through and do that, and that's why we provide the free analysis. And really, the devil's in the details, because sometimes someone will say, "Well, how much is a $10 million multifamily?" Well, again, the answer is going to depend. Let's say it's a $10 million and it is one structure within an inner city area. There's no parking and things of that nature. Or maybe it might be like one I did here recently in Kansas, where it had a number of units that are 1 or 2 stories over a number of acres. Well, it's going to take a lot more work to be able to go through and do one of those other ones than the one structure. One thing to keep in mind, that when we do a physical site visit, if let's say there are 20 units in a multifamily unit, a building rather, as far as the pictures are concerned, what we'll do is we'll take pictures of all the common areas and exterior, of course, but then what we'll do is take a picture of each one of the representative units. Let's say they have a 2-bedroom, 1 bath, or a 3-bedroom, 1 bath. We'll just need to take a look at each of the representative units in that particular case. Did it answer the question? Okay. One thing that's interesting, I don't know how familiar any of you are with a real estate professional, but there's a designation that if someone's a real estate professional, there's other advantage that you have. And I'll give you an example of one client. Each year he comes back, he's buying a lot of properties, and he's a neurosurgeon on the East Coast. And in the course of conversation, he said, "Oh, by the way, I have a spouse who's a real estate professional." Well, he obviously understood the benefits of that, because the tax savings could not only go against the property, but any excess could also go against his W-2 income. So that's a huge factor. Just Google real estate professional if you have any interest. You can take a look at what the guidelines are for that. One thing I do recommend is that if you have a full-time W-2 job and you claim to be a real estate professional, that's going to be a big red flag to the IRS, and you could very likely get audited for something like that. So if it is something you qualify for, make sure you document all the information, all the hours that you spend, and what you're doing to be able to qualify for that status. Okay, let's move on. These are just a couple of examples of some properties that we've done.
And Mark, I had a question. If you're planning to refinance the property in 3 to 5 years, how does that affect the accelerated depreciation or affect the recapture rates?
No impact.
Oh, awesome.
If you sell, that's a different factor, but if you refinance it, it doesn't matter.
And what about renovations? I mean, obviously we're in the value add sector, most of us, and should we wait till the renovations are done, or can we do them when year one, year two, year three, or at the end of the renovations? What do you suggest?
Yeah, that's a great question. I do a lot of those where someone will buy maybe a multifamily Class C, convert it to a Class B. And the answer to that is it's going to depend on when they do it within the calendar year and the tax season, and whether they want to file on time or they want to do an extension. What we'll do is we'll do an analysis for not just the acquisition, but also on the CapEx. And what we'll do is, let's say they buy in January and then they're doing renovations throughout the year. We'll do a cost seg on the acquisition itself, but then at the end of the calendar year, we'll ask for all the details of what was done with the renovation, and our analysts will do that and provide a separate report for the CapEx analysis and the tax savings associated with that. We all know that, especially with larger properties, that it could take multiple years. In a case like that, what we would do again is either wait until the renovations are completed in that calendar year, or in December, if they're still going to do some in the next year, and get that information and provide the extra study for that. So again, sometimes might have someone who does an acquisition and we'll follow up with the renovation studies for the next 2-3 years, or however long it takes. Okay, well, what do you think? Is that an ugly building or what? One thing that's interesting about this is that it's not based on the attractiveness of a building, what your depreciation can be. One thing you won't see in this picture is that this property had a massive parking lot area, which we were able to get some incredible savings for them on that. So our studies are very exhaustive, and we will take a look at everything that we get the maximum amount of depreciation and tax savings for our clients. So we go on the next one. One thing I mentioned earlier was the fact that we can provide a free preliminary analysis. We'll ask some questions such as, what's the building type? When was it placed in service? And what's the address, and things of that nature. And within a couple business days, 1 or 2 business days, we'll come back with that free analysis, which will give you an estimate of what the conservative estimate, and then a high-end estimate. And almost 100% of all of our studies will fall within that range. I recently had one here recently, and this doesn't happen very often, but we actually our savings were 100,000 greater than what we had estimated for a number of self-storage units that I did for a client down on the Gulf Coast. Okay, we move on. And just kind of address your other question there, Anthony, in regards to renovations, or something called a PAD, or a partial asset disposition. And we go on to the next page. And what that does is it gives us the ability to be able to identify a lot of different tax advantages that people can make as far as doing their renovations. Now, cost segregation is what we've done for many years. In more recent years, we've made some acquisitions, and we're doing some additional tax studies as well. One is for research and development tax credits. This could be, there's a whole series of industries that could be applicable for. It could be in the food industry, where they're testing different things, pharmaceutical, manufacturing, breweries. There's all sorts of companies that can avail themselves of this. We also do what's called a Section 179 energy tax credits. This might be involved with some LED lights, retrofits, and things of that nature. And one of the other things is we have something which is called a green zip tape. And what that will do is, and won't get too much in the weeds here right now, but it will make interior non-load bearing walls depreciable. because normally what you cannot depreciate that. It has to be a straight line method, again, for interior non-load bearing walls. So within, let's say, an apartment building or student housing or medical or things of that nature, there will be the interior walls. And the installation process for this green zip tape is the only one which is approved by the IRS. They did a test of about 16 of these different tapes. This is the only one that passed the test. It's not a tape which is commercially available. It's available through us through a licensing. And during the installation process, rather than nail in the sheetrock, what you do is you nail it in. And if you ever need to do a repair behind the wall, maybe it's a plumbing or electrical issue, you just pull the tape off, you pull the sheetrock off intact, you fix the problem behind the wall, and then you put the same piece of drywall or sheetrock back up. And the advantage of that is that's not going into landfills. For those of you who are familiar with LEED credits, that's LEED credits, environmental ones that will save up to 17 extra LEED credits. Some of our clients are going from a gold to platinum. But the real advantage here is that the tax savings, even if you never even remove the wall, it classifies as being removable, and therefore you can get about 5 to 10% off your construction with the depreciation. And it's mostly for new construction, but it might be for adaptive reuse. A situation like that is, as you're probably aware, there's a whole lot of excess office space within the country right now. And there's a number of projects that are being done to convert the office space into multifamily. So that'd be a situation whereby you might have one large open space that was for an office space, but when you put up walls in it, that's something that could qualify for the green zip tape. Okay, let's move along. We kind of covered this along earlier regarding the number of studies we've done. Completed studies within 4 to 6 weeks. We're actually more down to 2 or 3 weeks right now. It depends on the size of the property. And we do the other studies like I mentioned there earlier. And one thing to keep in mind is that what I mentioned before was that we represent the study in the event of an audit and no additional cost. And we'll do that at free, at unlimited expense. And that typically is not too much of an issue, but it does come up on occasion. And I work with a lot of CPAs. There's some that are very well versed as far as real estate and cost segregation, and we provide the study to our clients and to them, and we never hear back the majority of the time. There's others that may not be as well versed in it, and what we'll do at no additional cost is we'll hold their hand and walk them through the process as far as what they need to do to be able to utilize our studies for their clients' tax returns. Okay, that's pretty much it. Thank you so much. Appreciate the questions, and are there any more we can address?
Thank you, Mark, for that information so far. What it sounds like to me is that cost segregation and ensuring that you find someone specifically, you that you're providing us the information, but to ensure that we find someone that helps us in getting that cost segregation, because otherwise we are missing out on tons of benefits and tons of opportunities to save lots and lots of capital for whatever kind of property that we have.
Yeah, that's true. And I work with a lot of individuals who own properties, but then a number of syndicators as well. And for those of you that are limited partners, you get the K1s, so you know what that is. Frequently, that's as a result of the cost segregation studies, which can give you tax benefits, not just for the general partners, but the limited partners as well.
Nice.
Beautiful. Vicky?
You're
Feel
on
free
mute,
to
Vicky.
unmute yourself.
Okay, can you hear me now?
Yes.
Okay, so I know so we have single family rentals or have had in the past. And I know that when you depreciate stuff on your taxes, and you turn around and sell it, the depreciation gets rolled back into it when you sell it.
Right, that's called the recapture tax. I addressed that earlier when I suggested that we recommend that you hold a property for at least 3 to 5 years, so that the return on investment you're going to get on the tax savings is going to far outweigh whatever the recapture tax is. So if someone comes to me and they said, I'm planning on flipping this property in the next year or two, we don't suggest that they go ahead and do it because of the recapture tax. One way to help alleviate that is through a 1031 exchange.
Okay, but if you hold it for 5 years, the offset between the what the recapture would be versus what you would get, you would still, in a sense, get a benefit from it. Then, am I correct?
Correct, because the clients that we work with, when they get that money, let's say it's $100,000 or whatever it is, they don't stick that under their mattress or put in the bank at 1 to 2%. They make that money work for them. They go out and they buy other properties. They do other things, and typically they're getting double-digit returns on that. So when you take a look at what their tax savings are from the cost segregation study, and you take a look at compounding that over the number of years that they hold it for 3 to 5 years or longer, the return on investment they're going to get on that savings is going to far outweigh whatever the recapture tax is going to be.
Okay.
It doesn't
Now,
have to.
now I understand.
Does it have to be
Okay.
300,000 or greater?
Does it? But okay, on the piece of property, the value has to be. Is there a minimum or a maximum dollar amount?
It works more economically for those that are $300,000 or greater, excluding the land value.
Okay, and in most cases with multifamilies, you know, if it's a $5,000 value, most of the time you're looking at, or $5 million value, you're looking at a $4 million appraised value on the piece of property, or 3.5 somewhere in there. So, okay, thank you so much.
Yeah, you're welcome. And that's an interesting point as far as excessive value. Like I actually had a client today to send me information, and then looking at the research, he gave me one cost basis for it, but I did some research and I noticed that it was that when they were purchased, it was actually significantly less. So I think what he gave me was the appraised value. The appraised value is immaterial for a cost segregation study, and from the IRS standpoint, you have to take a look at what did you actually pay for the property. That's the number which is used.
Okay, thanks, Mark.
You're welcome.
What it sounded like to me, Mark, as well, is that the cost segregation study and the bonus depreciation is best for us to do it when we are coupling it with a sound strategy of how we're going to use those savings in order to have a lot more returns. Otherwise, if we just put it, as you mentioned, under the mattress, or we just put it in our savings or in a bank account, then we're not really utilizing the potential of those savings whenever we go ahead and sell the property.
That's right. And again, all the investors I work with, they're very savvy with their money. They make their money work for them. So, and that's what they do. They take a look at those savings and they plow it into other properties.
So, Mark, from your perspective, what's the biggest mistake investors make when it comes to depreciation strategy?
I think I've actually had this question from some people, which have said, what's the property that I should get that will give me the maximum amount of depreciation? And even though that's what I do, I say, I don't think you should look at it that way. As an investor, what's the best deal that I'm going to get return on investment? A cost segregation study is not going to make a bad deal good. What it's going to do is make a good deal better. So you need to take a look at all the fundamentals for acquiring a property, and what's the fundamental on that as far as being able to get the best return on investment, and then your cost segregation just going to be cream on the top of that.
Love it. I love that saying, is like where cost segregation doesn't make a bad deal good, but it just makes it better. right? What a good deal. And so I love that tagline, and it's really true. Too often we lose sight of what's the purpose of acquiring this building, rather than
Right.
like, okay, does it actually pencil out in the beginning before you even get into the deal? And then now cost segregation is just, again, it's just, gravy on top.
Right.
Thank you.
Yeah. Don't lose sight of the fundamentals.
So do you handle studies for portfolios or people who have multiple properties? Do you bundle them, or is it just case by case?
I do a lot of them. Like I'm doing one this week for 4 properties in Michigan, but I've done a number which are. I had one where someone approached me for $20 general stores. So we'll do. I do a lot of portfolios, but also single homes as well.
Perfect. Thank you. I have one more question though, actually. I'm sorry, apologize everybody. I'm hogging the mic here. But what's the best way to coordinate your study with a CPA to avoid any surprises during tax prep?
Well, you want to make sure that you do it in sufficient time. If especially this time of year, tax time, whether you have your business taxes, which are due March 15th, and your personal taxes, April 15th. You want to be cognizant that you have plenty of time to be able to get the study done if you're not planning on extending your taxes. So in a case like that, I would recommend, don't wait till March 1st to be able to get started. If you need it for March 15th, we might be able to get it done, but make sure there's plenty of time, because also CPAs are going to be slammed a lot with a lot of returns. They're very busy, and especially if it's something which will require what I mentioned before about a 3115, which is if you acquired a property previous tax year, there's additional work which is required to be able to fill out that form. So don't wait. However, in a situation that maybe, like I said, if you have someone who's going to be extending their taxes into September, October timeframe, right now, in fact, I have some clients doing that. They know they're not going to get it done before this time, and their CPA is very busy, can't get it done. You can just extend it. So we're very busy. Well, we're busy all year round, but especially prior to the tax season in the spring, and then also in the fall. And again, don't wait to the 11th hour to get the process started.
So what is the most ideal timeline then? I mean, when somebody consider to possibly purchase a building or invest into a syndicated deal, when should they really be having this concept of, tax benefits? Should it be Q1, or is it, or like, can they wait until Q4? But that might be a little with a high pressure. Like, what have you seen in the market where most people would take advantage of this?
It really depends on when you're planning on closing on the property. Frequently, I'll have clients that will maybe they just have an LOI on a property, letter of intent, and they haven't closed on it yet, but they want to get a ballpark figure on what the tax savings are going to be for themselves and their investors. And we can still run that free analysis for them at that point in time. However, we will not do the actual study and don't want them to start the process until they actually close on it, because unfortunately, we all know something 11th hour could come up and just derail it. So that can occur at that point in time. It also depends on where you are in the calendar year. If you buy something in January, you've got a lot of time. If you buy something December 31st, you better get started on it right away. So it really depends on where you are in the calendar year as well.
Thanks, Mark. That's it for my question. Anybody else? All right. Well, if you don't, we are going to go ahead and wrap it up. Thank you so much, Mark. Appreciate all the time and the great presentation. This has been great. Hopefully, a valuable takeaway for all of you, whether you're a syndicator, operator, or investor. This is something that is definitely a tool under your belt that you can utilize and leverage. And of course, look in the chat. There's Mark's contact information there. But I would like to invite you guys to also, if you enjoyed the webinar today, we're hosting a monthly webinar typically every fourth Thursday of the month, but except for this coming month in April, we're changing things a little bit. It'll be on April 27th or 28th, I apologize, at 4 p.m. Pacific and 7 p.m. Eastern. In this one, we'll be unlocking the power of 1031 exchanges in multifamily investing. I'm sure you guys have all had some type of experience with either you're selling or you know somebody's selling their property and they're trying to continue on deferring their tax savings. And so this will be a great opportunity for you guys to learn a little bit more about that. So if you haven't already, here's a QR code, but Carla will be putting the link in here in the chat for you to register. And last but not least, feedback is so critical for us and for our success to know how we can be more nuanced on the information that we present to you. So Carla, if you can actually put the link in there for the survey. If you can just it should only take you guys maybe 30 seconds to a minute at most to complete the survey, but it helps give us invaluable information so that we can continue to provide you more great information going forward and inviting the guest speakers that are more catered to what you would like to cover. So again, thank you so much, everybody. Thank you, Mark, and hope you guys have a great evening.
Thank you, everyone. Thank you so much, Mark. Please fill out the survey. The link is already in the chat, and you can also register for the April webinar. The link is also in the chat. We'll give it a couple more seconds so you can click in those links. And again, thank you so much. We'll see you in our next webinar.
Thanks, everybody.
Bye-bye. Take care.
Everybody.
Bye.